Hello and welcome to Exchange Insights, your resource for 1031 intelligence and education. This is the first video in our three-part series called The Life Cycle of a DST. My name is Tom Wall. I'm a 1031 expert and partner here at Anchor 1031. Today we're going to be going over what you should expect and know before you engage in a 1031. So to start us off, we'll talk about how a DST comes to market. A DST begins life with a sponsor. Now, a sponsor is a real estate investment firm that identifies a property that they want to offer to 1031 exchange buyers. So they go out, they buy that property, they stabilize it, and they put it inside of a Delaware statutory trust. From there, it's the sponsor's job to execute the business plan, to manage the property, communicate with investors. They send out tax reports and provide periodic property updates. But most importantly, their job is to ensure that the asset and the trust are properly managed. So the way these DSTs and these investments come to market is first that sponsor identifies a property that they want to manage as a DST. They want to offer it to 1031 buyers. They go out, they buy the property. They have to put their own money up to close on it, and then they create this trust structure, this Delaware statutory trust, and they put the trust on title. So at first, the sponsor owns 100% of that trust. The rent's going to flow up from the property, through the trust, and into the bank account of the sponsor. So if you're following, the sponsor's already closed on the property, they own 100% of the trust, and their goal is to manage that asset. They're not typically equity investors, so their goal is to sell off shares of that trust to DST or to 1031 exchange buyers. Investors are able to buy their share of the DST one by one. In other words, DST investor number one can close today. They can buy their interest in the DST right as soon as their cash is ready to go from their exchange, and they start earning revenue right away. They do not have to wait for any of the subsequent investors in that deal. Aside from ease of closing, investors don't need to worry about negotiating with the seller. They don't need to navigate their way through escrow, and they don't need to overcome any of these potential hurdles or pitfalls that we see take place when individuals go to transact and buy real estate on their own. DSTs make a lot of sense for 1031 buyers because they've already been bought and stabilized, deals closed, the due diligence has already been completed. They're sitting on the shelf ready for 1031 buyers to purchase, and so it's easy for 1031 buyers to line up their timing and eliminate that risk of not being able to identify their property and close on the investment within your 1031 timelines of your 45-day window to identify and your 180 days to close. So once the sponsor has the property stabilized and the property's in the trust, it's considered syndicated. This means that the trust holds title of the property, and the DST sponsor can now go out and sell interests of that trust to investors and bring in 1031 buyers. So the DST sponsor is an asset manager. They do not typically have relationships directly with potential investors, so they rely on brokers and advisors to find investors. In order to bring the DST to market and start raising capital from retail investors, sponsors will collect their due diligence and third-party reports. They package them up and share them with brokers who will then conduct their own due diligence to determine which of their investors, if any, are a potential fit for that specific investment. Now, the due diligence package will typically include lease audits, estoppels, engineering reports, surveys, different various appraisals, and of course reports on that specific market, demographic trends, things like that. All of these are compiled for review by what we call broker-dealers. Now, the broker-dealer that we work with is called Great Point Capital. Great Point works with a handful of carefully selected sponsors in the 1031 exchange industry, and their team runs background checks on each sponsor, reviews track records and company profiles to determine whether that sponsor makes sense and is suitable for our investors, and determine if we include it on our platform. When these select group of sponsors want Great Point to recommend a specific DST that they're bringing to market to our 1031 clients, that sponsor will submit their due diligence to our team, and our team will review third-party reports, appraisals, they'll review inspections, engineering reports, lease audits, and they'll carefully examine the business plan and all financial assumptions made by the sponsor to ensure that the investment is a viable option and suitable for our investors. Our team will compile questions that to be answered by the sponsor's asset acquisitions team and asset management team. And if these answers are satisfactory to our due diligence department, we'll decide to add those DST to our platform. At this point, your 1031 registered representative, myself, can use this DST as a potential option to add to an investor's portfolio. So how do we determine which DSTs are suitable for each specific investor? We do this through a series of long conversations where we get to know our clients, we educate them, we walk them through the potential upsides and drawbacks of each potential investment. And we have a special focus on making sure that they understand different risk factors associated with each investment. Now, two properties can look very similar on the brochure. Two multifamily properties, similar cash flow, even the same market, but their business plan or their underwriting might make them have a completely different risk profile, different upside profile, something that investors should be aware of when comparing one DST against another. It's important to talk to your registered rep and make sure that you understand the risk factors of each. So usually, this is a process. So we like to engage our clients months before they're ready to transact because we like to do this thorough education. We want to make sure that all potential risks and benefits for each DST on our platform are well understood by our investors. And we may come to the conclusion that DSTs are not a good fit for you. We may recommend another asset class such as tenants in common or TICs, or maybe in the best interest for a client to buy a property outright on their own. Or there might be a specific investment that aligns with an investor's goals that we're just not the right partner for. So we may recommend that you go somewhere else. Either way, this is a decision that's best made well ahead of a coming 1031 exchange, because once you're in a 1031, that clock is ticking. There's a lot of pressure. You don't want to be under that kind of time crunch when making big decisions about your family's financial future. So as I mentioned, I talked a lot about risk during that education process. It's a primary focus of ours, is highlighting the risks involved with private real estate securities investing. So we're going to talk about potential risks of debt, how that debt's structured, who the lender is, when those loans come due, what are your options. We'll talk about potential causes of cash flow shortfalls. We'll talk about what happens when a balloon loan comes due and how to mitigate the risk of balloon loan timelines. We'll talk about the cross-collateralization of properties that are purchased using the same CMBS loan and how one property's potential trouble could cause an entire portfolio to struggle. We'll talk about bank foreclosure risk and the risk of certain cyclical asset classes and if it makes sense in this market environment to look at those. Our goal is to make sure that our investors properly understand all of the worst case scenarios, not just potential benefits that can result from investing in a portfolio of DSTs. We want our investors prepared for the worst. So once we have these series of conversations and provide us education leading up to an exchange, we start looking at actual investments and working to build a portfolio for our clients. We start by introducing them to different sponsor groups, educating them on who could be a potential partner to complete their 1031. We help our clients select a portfolio to balance their risk profile with potential to meet their goals and objectives in the way that they choose. So after we interview sponsors and start narrowing in on specific properties, we reach out to select sponsor groups to make sure we can set aside equity in those investments by making reservations. So the sponsor will keep a ledger and earmark some equity in your name in that specific property to make sure that there's space in that deal when your actual 1031 exchange closes and you have the cash ready to invest. The last thing you want is to spend all this time doing due diligence on a property, deciding to invest in it, and your sale closes and all of a sudden that deal sells out and you're not able to get into it. We can mitigate that risk with this reservation process, so make sure you tell your registered rep when you have interest in a specific property. That's all for this video. Next time we'll be talking about the logistics of completing your 1031 exchange. My name is Tom Wall, partner at Anchor 1031. Thank you so much for checking out Exchange Insights, your resource for 1031 intelligence and education. Sign up on our website at anchor1031.com for a consultation if you'd like to discuss your specific situation. Thanks again. We'll see you next time.